All right. Good morning, everybody. So let's start with next week. Next week's going to be a short week. Monday's a half day, Tuesday we're closed, and then we're back Wednesday, Thursday, Friday. That's a lot to kind of cram all of the data that we need into those 3 short days. And one of them is going to be a really big one, the ADP employment report. So really look at what you're holding in your portfolio and ask yourself how comfortable you would be if the S&P was to make a 5% move up or down between now and say mid-July, right? July 15. That'd be the second weekend Friday, because that's what's on the table, right? We got a lot to unpack next week. We got the FOMC meeting minutes. So that's not a new FOMC meeting. It's just the minutes from a previous meeting. But those minutes get scrutinized heavily to see how well Powell summarized the meeting and to get more specifics, right? Because Powell does a summary, but he doesn't get into the specifics. And these minutes are developed, right? It's not like someone's sitting there taking stenography notes, or I know I butchered that word, but someone's not just sitting there typing up things as they talk. They compile minutes after the meeting and then release them today or on that day, the 5th. Not only do we have ADP on Wednesday, but we also have initial jobless claims on Thursday, and then Friday, a lot of unemployment and a report on hourly wages and all of that. So like next week is all jobs. And jobs are one of our leading indicators on the Fed's goal, right? Not, I shouldn't use that word leading. I mean, it's one of our highest used, right? It leads the list of things. It's not a leading indicator. It tops the list. So really worth considering how next week could play out. This is what's going on around the world right now. And we can see change and change percent. So around the world, we were bullish the market. Some of these are a little flat, really didn't do much. And then others expanded really nice. And think of each of these as their own index, right? So when you see that it's up 1%, that would be like saying, oh yeah, the SPY is up 1%, or the Qs are up 1%. And if it's up, 0.07%, not even a tenth, then, it'd be the same thing. Thinking of SPY sitting near its open or something like that, having never really advanced too far on the day. What we're interested in is, will this overnight tailwind give us a little boost through our trading day and through this Friday? Bringing it back to today, you can see the dark spots here indicating that we've got some high volatility anticipation coming through, right? Some of the data is expected to be impactful. Now here, FX Street was talking about how firm PCE data could give the dollar a lift. And that's through Scott Bank. And if you think about how that's going to affect, say, US dollar Japan, we're kind of watching that level, right? That 144. So certainly worth keeping that in mind. 144, 145. I think 145 is the top out point, right? We're expecting it to reverse there and hopefully hold the line. So could overshoot, could get above that level, but we want to really see it come back in and close. If we don't close above, if we don't close below 145 on US dollar Japan this week, then we want to see how it opens, how that new weekly candle opens. Yellen is chipping teeth, but so far she's not saying anything new. She's just kind of rattling her gums. She will be speaking again at 10. So really, you afternoon 0-day traders shouldn't have any issues, right? There's really nothing into the afternoon that would be too impactful for your 0-day trades. We still got that 4,000 put wall on the SPX. We got a range high of 4,500 with interim support at 4,320. And of course, the pivot level, 4,400, and major resistance at 4,400 to 4,415. And for the Qs, major resistance at 370, support at 365, and then 360. There's a JP Morgan collar roll that's going to happen today. And so a lot of people are focused on that roll. And we're starting to get a volatility smirk. I know it's kind of getting a little bit into the weeds. It basically affects how your out of the money spreads are affected, right? And I've talked about that before. How volatility increases or decreases the options price, and then depending on the one that you're selling versus the one that you're buying, moving up or down a little bit when you're out of the money can drastically alter how much credit you get for your out of the money trades. We're still looking for a crossover here between the red and the green. It's pretty simplistic. When green crosses above red, that's a go long signal. And when green crosses below red, that's a go short signal. Any Discord that has the trading tick bot, you can use the command to call this thing up. You just use the market flow command, and you can do no number behind it, which will give you the current day, or you can go up to 5 numbers, and that will give you a 5-day point of view like we're looking at here. This is a 5-day point of view. So 8:30, 9:45, 10, 10:30. The rig count at 1, but I used to work on those rigs, and the numbers should not change on a day-to-day basis, even a week-to-week basis. So unless they came out with a new style of rig, like a new fleet, and then had to do a recall on the entire fleet and put every rig into the dirt, you shouldn't see a drastic change in those numbers. So, you know, it's possible, right? It's possible, but it's not probable. So you can just discount that one. Basically, after Yellen, you're good to go. I've had a lot of people that say they don't understand what I mean when I say watch the clock. I get it. I mean, you know, I tend to do things a little different than everybody else and focus on things that maybe others don't focus on. But there's nothing secret or special or You know, it's simple. I mean, watch the clock. What time of day is it? The government is lazy. There are all of these different economic reports, and these are not all of them, right? This is only some of them. And if you notice when you go to different places, if we go over here, world indices, you know, I could go to a calendar here, it might have some, and then we can come here and we got some more. And then, you know, we go here and we got some more, and they're all showing us different things, and some of them overlap. And it's still not all of the economic events that happen 24 hours a day all around the world. There's economic data coming out constantly, but it's not coming out at 11 after. It's not coming out at 18 after, right? Or at 7:49 in the morning, on the half hour and on the new hour. Look, we got 4 a.m., 7:30, 8:45, 9 o'clock. What you don't see is 7:44 a.m., right? It's 7:16 and something like that. So rather than trying to hunt down and memorize and analyze every single minor data point that might come out all around the world at every hour and half hour, we can just look at the clock. Is it near a new hour? Is it near a new half hour? If it is, and price is tightly wound, it's very likely just ready to break that boundary and watch the volume come in on the new hour. There's your trade. If we're near the session high or the session low and it's coming into a new hour, get ready. You're going to get the volume and we're going to make the move. All right. So does it happen every half hour and every hour? Of course not. It's not always going to be that way. But if you used a normalized chart, the 1 minute is what some real popular analysts use. If you go to the futures on a 1 hour or on a 1 minute, excuse me, and you look at volume on the half hour and on the hour, you'll see that uptick in volume. And if it was one where we were at the high of the day or at the low of the day, if it was, you know, Globex low, whatever, you're going to see even more volume. And it's very likely where the big move came, the reversal came, the change of market structure came for the day, like yesterday here at 2 o'clock. One last hurrah to the downside and away we went, change of structure, right? So 1 o'clock, dropped down to tag the VWAP. It dropped out of that box that it had started to consolidate in. So watch the clock. It really is no more complicated than that. Watch the clock. Plus, you get things like the 5-minute bar. That one bar controls things for the entire trading day. You can use it to measure expansions, or if we're still sitting inside of it, then you know not to do anything. You know, if it's noon and we're still sitting inside that 5-minute bar. So how that 5-minute bar opens, what direction it goes, how it closes, all of that is really important for the rest of the day. We gauge it, we measure it, we plot it out. Why? Time. Watch the clock. The volume is normal today. So even though we are headed into a short weekend, well, a normal weekend, short week next week, they're certainly not sitting out today. And it doesn't seem that they're holding back. So they're not really too concerned about the data that's going to be coming in. We're not seeing a lot of fear here, but we are seeing that they're hedging. That's why there's this market maker move up here. If you're unfamiliar with where that market maker move comes from, it's a think or swim thing. They made it up, right? They're the ones that inspired me to make up things like the Busby. I mean, if they can just pull this rabbit out of a hat and just say, hey, we call this thing a market maker move. Hey, that sounds cool. Well, we can make whatever we want, right? So where does it come from? It's when the front series has a higher vol than the next series out. And in this case, we got 11.7 versus an 8.8. The difference between these two is why we have a market maker move right now. Normally it's seen in things that have an upcoming earnings or, you know, some kind of investor conference or a new product release, something like that. But it can also happen in the futures when they're hedging right before an event. FOMC, CPI, PPI, something like that. And that's all that's going on. Increased options trading will increase the volatility. The more the options are traded, the faster they're traded, the more aggressively they're traded, the higher the volatility will rise. So their aggressive trading in this front series increased the volatility higher than the next series out, which caused the market maker move. Now, I've heard some really smart people who I'm not going to name them. There's no reason to shame them, but they are well known. They are famous. They run their own, trading firms, and they're public people, and they have screwed this all up when they've tried to explain it. It's like they just have no idea and just rattled off a bunch of junk. So don't take my word for what I just explained here. You can read all about it. Since it was developed and made by Thinkorswim, their publication, the Ticker Tape, explains market maker move, and they have like 50 articles on it. What it is, where to find it, how you can use it, all kinds of things, right? So me, I'm a nerd. I read all the articles. I've had people say, I don't want to read 50 articles. Just read the one that is titled, What is Market Maker Move and How Do I Use It? Read that one. Wow. Good morning, everybody. Hope you got good plans for the weekend. We are a little extended from the VWAP this morning, so I'd be looking for, a little pullback here, maybe to that 44.50 voodoo line. I keep mine lightly shaded so that they're not very bright, but there is a voodoo line there at 44.50. It is also one of those gamma levels, right, between tier 1 alpha and spot gamma, and I'm sure there's another firm out there, at least one other firm. I think it's Voltrade. Maybe it's Voltrade. So a little pullback here, getting closer to the VWAP. I'm kind of looking for a rug pull, right? This seems like a nice little blow off top to that rising wedge. Remember, rising wedges generally break to the downside. It's what they're supposed to do. But oftentimes we'll see this last hurrah first, this little blow off top, and then it falls through the bottom. So the break upwards and the global spur through the overnight isn't giving me that warm, fuzzy feeling of going long. And instead, I'm more leaning towards the idea that we come back in again. But we want to look for shenanigans, right? It's kind of the idea that one, there is that JP Morgan collar, and we have pinned to that thing in the last few months. You're talking about a few months out of the last years that it's, been doing these rolls, and there's periods of time where we don't even get close to it. And then there's periods of times where we hit it again and again and again. So there's that. And then there's the idea that if everybody's already short this and they start to get squeezed, they're going to buy to close their short. It's going to add to the push, and it's going to be more push and more push, right? It's just going to be like this day back here. The more people tried to short it, the more it rallied, the more they squeezed those shorts, and then it rallied more, right? And more and more and more. I was looking for that JP Morgan collar. I had it marked and then I deleted my line. I'll come back to it. I know TradyTix has that level marked out as well. So we are above the 10-day moving average, the 10 EMA. We have an MDP. It's a missed daily pivots. So far we haven't hit it. That doesn't mean that we can't. And you got to keep in mind that we generally hit that daily pivot point about 80% of the time. So when we don't hit it, it kind of stands out. The strategy is called an MDP, missed daily pivot. It's not mine, by the way. So I don't trade it. I don't teach it. You can find it though, if you were to hunt on YouTube, whatever. I think the guy did a good job of explaining it. I like to use it as a part of my analysis, even though I don't trade it, right? Because it does offer some insight, and it's a great learn, really. A lot of strategies that I learned were worth learning because it added to my depth of understanding for, market structure, even though I don't particularly want to use the strategy for a trade. So something to consider. The TRB setup that we had talked about and called out is still doing good. Trendline breakover. It would have been a much cleaner, better breakover if it had made most of that move back in a single day, which is why we like the trendline breakover so much, because you generally get that one candle that is 3 or 4 times the size of these other candles. We didn't get that, but we did get that nice bounce on the 20. We crossed through both EMAs at this point. The EMA and the SMA. And we got nothing else that could really get in front of us, right? Or even above the 4. Bullish strength, bullish trend, bullish momentum with a surge upwards. I mean, that just about sums it all up right there. Ten-day, 30-minute volume profile. When we're at the high, we expect to go to the low. When we're at the low, we expect to go to the high. We are well established past the point of control at this point. We're moving through that air pocket, but we're building out here. There was a lot of volume that wasn't here yesterday, right? And we haven't been here very long, so you got to kind of take that into context. That's a lot. Looking at it from a 10-day point of view, it kind of maybe provides a little insight on this activity that we're getting right here. Either way, through this shallow area, we should move relatively easy. And then we start getting into structure again at around 44.75. We have another VPOC. So yesterday formed a new one. Yeah, look at that volume. So what I just activated here is the TPO. This profile here in blue, that's a TPO profile. Here in green, that's a volume profile, right? Two different things. What I wanted to see was how much time have we spent up here? Because looks could be deceiving. we could have been up here longer than I believed we were. This says we have not been up there very long, and yet that's where the greatest amount of volume is. So what's that tell us? It tells us that we ran up here and that the bulk of all of the volume today was in this range right here. In this small amount of time, this is where the greatest amount of trading has taken place. All right, you see all that volume here. So we spent the greatest amount of time down here, which makes perfect sense. We were there all night. And yet we had the greatest amount of volume done right here. Are they unloading? They loading up for a big move? Now ask yourself, are they going to load the boat to go long at 8 in the morning before market opens with this short week next week? All these things that we've already talked about. You think now's the time for them to buy up and go long? I don't think so. So what's more likely, that they're getting out of their positions, that they used that 44.50 level as a line in the sand and went ahead and started using that to get out? Yep. Kind of adds to the base case scenario that this is going to be a rug pull day, an aha gotcha moment. This is the weekly expected move. I did a new video on this. I think that'll be like video 20 at this point. And I added the link to that video, I believe, to the description on the YouTube playlist of this morning briefing series. So you just go to the morning briefing, look at the video description, and you should see that new weekly expected move video in there. The market's not closed, so next week's box is not yet set in stone. Couple things to keep in mind is next week is a short week. We want to compare the volume of the volatility measure of that short week against the volatility measure of this week. And they're the same size right now. That ought to give you a little concern. This week that we're in right now was based on 5 trading days, and it's this size. Next week, Tuesday we're gone, Monday's a half day, and yet they're still pricing in the same size of volatility. So I'd say it's more volatility, right? If you think about it in distance traveled, you got a car that's doing 70 miles an hour and it drives for 1 hour, it went 70 miles. Well, how about going 70 miles in 30 minutes? You still went the same distance, you just got there faster. This is the same distance and it says we can get there faster. We are outside this week's range, and we close inside the range 80% of the time statistically. Having said that, when we break outside of the range repeatedly, 2, 3, 4, 5 times in a row, that's a really big warning. They can get it wrong once in a while, no big deal, it happens. But when they start getting it wrong back to back to back to back, that's a huge warning. One of the warnings that we had right before everything crashed in February for COVID. Y'all remember that? Sitting at all-time highs, markets ripping, everybody's happy. This thing started breaking out and closing outside the weekly expected move repeatedly. So the week that I just highlighted, we closed outside the box. The next week, we closed outside the box. So far this week, it looks like we're going to close outside the box. That'll be 3 weeks in a row that we've closed outside the box. That's a huge red flag. That's a huge heads up. Something is going on. And if you don't have any hedges on, if you're not running any insurance yet, you might want to consider it. I mean, insurance is really cheap right now. If somebody told you that you could insure your house at the cheapest you've ever been able to insure it, wouldn't you do it? Especially if you lived on the coast and you were getting into hurricane season. Yeah. So this is the VIX. We're sitting at 13.5. That's cheap, right? Insurance is cheap right now. So hedges are designed to lose. That's what they're supposed to do. So if you're thinking, yeah, I could use another trade, I'm just grab me some of those VIX calls. You really don't want to do that. For a trade, the VIX sucks. If your goal is to just get some trades on, go get some trades on somewhere else. Don't use this thing. It's a turd. But if you've got a portfolio and you're holding, say, I don't know, $70,000 in trades, and your beta weight says that you're going to take a significant gut punch if the S&P moves 5% in the next 2 weeks, you could spend, say, $100 on insurance, and if the market doesn't have a significant event, you lose your $100, but your very large position doesn't get hit. Right? So it's like insurance on your house. You don't want to burn your house down just to get your insurance, and you're not going to hope that your house burns down just to get your insurance, but you want fire insurance anyways. So the VIX hedge is just like that. You don't want that thing to make you money. You want it to lose. So when you go in to buy those VIX calls, consider the money that you're spending, money that you're throwing into the fire. You don't want the money back, and you have no expectation that you're going to get the money back. You're just doing it because if the market does crash and burn, this will help alleviate the pain that your portfolio is feeling. When I'm on Trade-O-Bait, I use an indicator that puts the point of control on each candle. And it looks like this. And someone asked me yesterday if I had the same thing for Thinkorswim. And really, I had been thinking about it for quite some time. And I thought I was going to have to code it, which is why I just hadn't done it. But yesterday, I took the time to go in and was getting ready to code this thing when I realized you don't have to code this thing. It is already there. So if you use Thinkorswim and you want the volume profile per candle, all you got to do is use the volume profile, the one that's on Thinkorswim, and just adjust it to where it's running per bar, which is what I have it because I'm on a tick chart at the moment, or by candle. So I could set it to candle, and then, if I'm on a 5-minute, put it to 5, use the multiplier. So I use like minute and then set that to 5 if I'm on a 5-minute chart, or you can just use bar, leave it set to 1. And then you get that. I think, now that I think about it, I think that's the video. Or no, excuse me, I got it figured out now. I knew I added a link to these videos. What I added is the chart to this, to have this volume profile with the adjustments already made. And that's in the video description. That's what I added. I didn't add that weekly expected move video. My bad. I've certainly got enough of those out there. So if you go to the website, my coaching website, you should find those weekly expected move articles and all of that. All right. So I see Baidu's getting a little bit of volume this morning. Bank of America. So we're getting some financials popping up. Some dash for trash like AMC, Activision, Apple was all over the news this morning, and of course, it's getting a lot of attention. Talk about a blow off top. Man, the thing is, when it comes to Apple, you got to be careful with this one. Um, it has a habit of continuing to run a lot farther than anybody else thought it could run before it pulls back. Right? Like every market's got a measured move. It should go so far and then stop and pause. That's not new, right? Like, thanks, Captain Obvious. Apple tends to exceed those expectations constantly. So even though that was a really nice rising wedge, and even though we broke out the top of it like it's a blow off top, I wouldn't short that sucker. Not yet. It's way too strong. It's got way too much positive press. It's just not a short right now. LRE, low risk entry, says if you were going to short it, shorting it off of that high is the place where you could do it the cheapest with the least amount of risk. But everything is balanced in the market. Everything is fair. So if you have a really low risk, you have a low win rate projection. You're not expected to win very often when you run a low risk trade. So if you can increase your risk, you also can increase your win rate. By increasing your risk, that would be waiting for confirmation. So the confirmation would be first that we break back down inside the wedge, two that we break out of the bottom of the wedge. Just keep in mind the projection for this wedge is back down to the bottom here, so around 183. It's not like we're talking about taking Apple down to 150. That's not going to happen. If you're really lucky, it could get back to the 180. I don't think it's going to get that soggy, right? The full projection would be 183. Half that projection would be more around like that 185, right? So depending on when we break down, if you can see that the full move would get us around that 183. And of course, we would be breaking down, from like somewhere around in here. It needs to break down first before I could put that line in place, but we can project. But half of that line is around 185. Right, so we can use 50% of the measured move, and then we can use 100% of the measured move. So a short in Apple isn't very good, right? If you wait for confirmation, by the time it breaks out and you finally feel it's confirmed, the short is there, you get what, $1.50, maybe two, and then the trade is done. So the LRE is a much better trade, but it's just going to lose more frequently, right? Because you don't have confirmation of a reversal yet. You just have the fact that it's sitting at those highs. But trading isn't about how often you win and lose. I'm not keeping score. This isn't a ball game. Trading's about how much money you made when you did win and how much money you lost when you do lose. Some of the best trade strategies that I have lose 80% of the time. That's 80. And they're some of my best strategies. Something to ponder on, right? So for Apple this morning, let's see it reject at that 190. LRE short there. Buying a put right at the money would be the easiest way to go, right? That's going to be the most costly. If you did buy out of the money, it will work. You just need the move to happen really fast. So, buying options, you need to have the move happen. The faster the move, the more it's going to monetize. The slower it takes, the less money you're going to make, right? That's the key to everything. So if you do buy an out of the money put here, say something cheap around that 185, 184 area, then you've got to have that big fast move or you're just not going to get it. Behind Apple is Bitcoin when it comes to how much cumulative overnight volume we've seen. So this thing's getting some volume and a little bit of a push. This is a continuation of yesterday, right? With all the Bitcoin proxies getting that lift. BITO is one of those proxies. But when it comes to proxies, things like Mara, Coin, Riot, those are going to be better opportunities, right? I know there's a lot of crypto lovers out there, but the one thing about crypto when it comes to trading that I don't like is it's one-sided. You can only buy to get in and sell to get out. You can't short that sucker. So if you know, there's some bend over backwards, shady shenanigans, wink, wink, nod way of shorting it, but 9 out of 10 people can barely use Google correctly, let alone try to figure out how to short, you know, Shiba or Doge or one of those others. So it's a one-sided market, long only. Trading the proxies or trading ETFs like the BITO gives you a chance to go long or short, and that's a two-sided market. Here's my crypto list. This list is not something that I put together. It actually came from the Smalls Exchange futures product. I just opened it up because it's much like an ETF, and I took the names out of it. So we can see that Bitcoin proxies are doing really good this morning. Nearly all of them are past my benchmark of 0.5%. PayPal, AMD, Taiwan Semiconductors, NVIDIA. I know those aren't really the first names you would kind of think of for crypto, but that's where we are, right? Like I said, I didn't make this list. But ones that are doing better are those more that closely resemble crypto and less about the blockchain. That Riot, man, it's a gift that just keeps on giving. Love this thing. So we do got this nice wedge, I guess not really a wedge. It's a trend line resistance there. And if we break that trend line resistance, we could measure this range down here and project it upwards. And it basically puts us into this liquidity zone around $14. So if we can get above 12, get through that resistance here, we could see a $2 move in Riot. Not in one day. I don't think it's got the EM for that, honestly, but yeah, it's got a 21-day average daily range of 88 cents and a market maker move of 23 cents. So we could just do a little rounding and call it, say, 110. We could double that and get 220, but we'd really need some volume to come in, right? Like really need some volume to come in. And this is bid a little bit, but looking at the cumulative volume, I don't see Riot in there, right? So this list that we're looking at, by the way, is things that have weekly options that also have penny wide bid ask increments on those options prices. So not all options are the same. If you're looking at something like the SPX, those options are nickel wide. You can't get penny wide in the SPX. It's why trading in this thing can be difficult, because penny wide increments have half penny size adjustments. Half a penny. When it's a nickel size price, the only thing you can do is go to the next nickel. That's that's $5. So this list is just using those penny wide increments with weekly options. And something has penny wide increments based on liquidity and it's and its price size, right? Obviously, the SPX is $4,000 product, you know, it's got a wider bid ask. So sitting near the top of the list are the FANG names, Apple, AMD, Amazon, and then we've got those China ADRs like BABA. All the ARKs, ARKQ, ARKK, they're getting a lot of love. That's that dash for trash stuff. Although if you look what's inside a lot of those ARKs, they're not trash, right? Not all of them. This ARKK, I mean, it's got Tesla in it. It had NVIDIA. Poor suckers sold it right before the big explosion to the upside, but whatever. You know, it's not trash. But we got Baidu, Baba, Billy. So we got a lot of those China ADRs. We already seen semiconductors. The list just keeps adding up, right? What do we got that's bullish this morning? Semiconductors, financials, the China ADRs, the Bitcoin proxies. What about pot stocks? Okay, so no real flow there. They're not necessarily down. It's kind of a mixed bag. Huh? Get it? Mixed bag. Pull the stems out, for goodness sakes. So nothing really in the pot stocks. Airlines have been ripped. They're still ripped. They're looking good. So, I mean, transports in general, right? Not just airlines. Their rebound was beautiful on that negative semiconductor stuff, right? And things like NVIDIA are still holding up well. We got a Busby at this point. A Busby only owes us back to the top, by the way. So if this rebound holds and we can get outside of that really big green expansion bar right there, then we could TRB and come right back up to that 440. Just no flow in the transports to be able to look at those yet. See, staples, defensives, utilities, they're not getting any flow really this morning. Not to say they're going to be down, just, you know, pre-market, they're not getting much love. So what we're looking at here is the S&P 500. We don't want the S&P 500. We want the S&P 100, but it doesn't offer me a chance to look at the S&P 100. So I use the filter and I try to get as close to 100 as I can based on the market cap. And what stands out afterwards are the really big boxes, which are the FANG names: NVIDIA, Apple, Microsoft, Google, Meta, Tesla, Amazon. So they are there, easy to see. They're the big boxes. And then there's shades of gray, red, and then green. The gray is because we haven't moved at least a 0.5%, which is my benchmark, by the way. If we haven't moved at least that far, we don't really want to take a look at it. And then it's grouped into different categories. Like we got finance here, electronic technology, technology services, health technology, retail, on and on. What we can see, electronic technology is leading the pack this morning at the most names. It's also where most of the FANGs are located. Financials are doing good. Now, remember this week, right? This week's been hard because we've had financials moving up and tech not moving up. And it's been just really difficult to trade. Not today. Today, we got both of them going up together. So that's really cool. When they work together, we get a beautiful market move. The thing is, you still got to trust it. And I don't, right? I'm still looking for the rug pull. That doesn't mean we can't go long. I want to see how we open, I guess. Get some of this econ out this morning, and then we'll see. We can also narrow this in a little bit. So now the benchmark to change the colors from red to green and away from that gray is much tighter. And now, I mean, that stands out. Pretty good scope on where things are at and where it's not at. Health services, communications, transports. Even though transports had been doing good, so far this morning, they're not. So, you know, when you're trying to day trade or short duration trade, you want to focus on the stuff that's getting momentum. That momentum should start in the pre-market. So if they're not getting love in the pre-market, probably don't want to focus on those for a day trade, right? We focus on something else. %18 of the S&P is up a 0.5%. I gotta say, that's not overly bullish, right? That's all. Just that. I think something might be wrong with that screener. I'm gonna have to come back in later and check. So here's the NASDAQ. 24% of the NASDAQ this morning is up at least a 0.5%. Again, that's not overly bullish. There's been mornings where we've come in and it's sitting at 50, 60, 70% of the S&P or 70% of the NASDAQ is all up a 0.5% or more. And this morning, 0.25%, 25 names. When we start looking through those names, it's not really exciting either. Right? We can see, sure, it's a lot of the FANG names. They've been down for a few days, so it makes sense that they're going to pop up now. But if they just popped off a support and are only rallying into resistance before rolling over to fall some more, then it's not much of a long opportunity. So everything is up, everything except bonds and gold. We can see junior miners and nat gas. All right, we're getting the dollar falling away. That's that 103 half area that we've been closely monitoring. As long as it's staying between that, we'll give it a little room and say that 104, 105 on the top side and 100 on the bottom side. If it's just going to bounce around in there like a pinball, then there's no real expectation of follow through anywhere else, right? If this is just bebopping along doing nothing, we're not expected to get nothing for anything else. Bonds, that was a really nice drop down the other day. And so far, it's just continuing. We're not getting any sort of a rebound yet. Although we did get inside day breakout and we're back inside it. So this is worth watching. If we get this kind of a move today going in the other direction, meaning a rip to the upside, we cross, say, 127 half, I think we're really going to feel that in the market. So that's something to think about. During that move yesterday, notice the S&P, how it really doesn't reflect that, right? It wasn't stocks versus bonds yesterday. The S&P was muted. We really didn't go anywhere. We stayed inside the Globex range through most of the day. But the bond move was hard and aggressive, and it timed with that Globex move nearly perfectly. So now they're divergent, right? Now things are a little split, not by much. Let's put them on the same time frame. It makes it easier to compare these two. So aggressive drop down in the bonds, a muted drop down in the S&P. A rally in the S&P, good size, right? And a muted rally in the bonds. And then they just opened. They've barely been open for a few minutes. So we want to watch these close. If we get bonds in here trying to make that recovery, we could very easily see more of this today. Started out kind of choppy, finally got going, and then, like pushing a boulder, it starts small and then picks up speed. Slow to start and hell to stop. Oh, yeah. At the same time, if we do get that, we can validate it with that move in the dollar. See yesterday how we had that drop here in bonds. We had that lift up in the dollar. We want to see that same kind of dichotomy. If we do get this pop up in the bonds and the lift begins in the S&P with an expansion to, say, 4,500 today, then we want to see that dollar break below 103 and really begin expanding back towards that 102 area. For US dollar Japan, that 146.41 is what I've got for a critical level. We're not there yet, but we had a really nice week again this week. Just a continued follow through. Here on the daily, though, you can see how we're inside day. And if this stays inside day, then it shouldn't be that bad. But if we break out of yesterday's low, then a rally in gold would be at least a day trade, a gold move to the upside. Right? This goes down, precious metals go up. Simple as that. So if this is going to go down, then this is a beautiful time to look for long opportunities for a short-term trade in gold or silver or miners. Or sure, we got a nice little setup there, TRB too. Okay, no, maybe not. When I get it out onto the higher time frame. That was a really nice recovery from yesterday. So, right, it closed here, it opened way down here, almost no tail on that thing, and then it rallied all the way back up, failed to break out of the previous day's high, and pulled back to close lower than the previous day's close. But this morning in the pre-market, we're up, right? We're up to 177.37, kind of split the difference. So 177.38 right in there. That's where we're at in the pre-market. So if we can get gold with an inside day breakout, say through the close of the 27th, that'd be 177.70-ish, right around in there. Then we could aim for 50% of that candle as target 1, and the open of that candle 179 for target 2. And if we did want to consider this as a TRB, if we did get a breakout above that 179.25, that high of that June 27, then we would target the close, the open of this candle here on the 23rd. So it's all going to start with a breakout, inside day breakout first. You could wait for an opportunity. So we got the close underneath this, and we're sitting, like somewhere right around in here. As we come into the open, if we drop down and we can bounce off of the close of yesterday, that's a nice springboard, perfect entry down here. If we don't get the fade to bounce off that 177, then an entry would be the breakout. You don't really want to get in if we're just languishing here in the middle, meaning we haven't gone down and we haven't gone up and we're just right in there. Don't do that, right? Get the springboard bounce or get the breakout. One of those two. We went through GLD, but I'm going to believe that the same trade is probably set up on GDX. It's a cheaper product if you're doing shares instead of options. Yeah, same setup, right? Gap down yesterday, a little more of a tail, rally back up, and that one actually closed outside, right? It made the breakout, but this morning it hasn't done anything. Closed at 29.62. We're sitting at 29.66. So, dun, da, 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 we didn't get anything. Target would be $30 for your first one, and then 30.5 for the second one. I like both of those targets. So we just got to have that follow through, right? If you're going to trade gold, really, 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 really keep your eye on US dollar Japan. Cool. Yeah, you like it. You like it. And yields are starting to fall. Makes sense. If we take it out to the daily, we can kind of see this liquidity is gone now. It got taken out yesterday. We made it through it. So I'm surprised now that we're pulling back off of it. But we had tried it here and just got resoundingly beat down. And then yesterday we got through it. All the way through it means we took it off the board. And we got through it in regular trading session. That's no pre-market stuff, right? That's a solid push through that level. But we're not keeping it this morning. So I would watch 50%. $13.08 is 50% of that big day. I'd watch that for a line in the sand. I think that just about covers everything I wanted to cover. All right, Amazon closed at 127.90 and this morning's at 128.90, nearly 129. So that puts us all the way up here. From a red to green setup, that's not too bad, right? We came up off of the low where we came down here and we hit this close and bounced off of it, rallied back up, closed off of the low. Looks pretty good. Got around that 128. Now this morning we're sitting at 129. So we're above the previous day's open. That's a good start. That means we can fade back to that for a bounce and a run, and or even better, a breakout of yesterday for a run. If you're going to look at the breakout of yesterday for a run, watch that 129.5. It's going to line up better with this open here. And I kind of like that better because of the 50% measure. I think that'd be a better one. So Amazon for a day trade, I kind of want to price something here. What about some lottos for like the 131.5 today? 0-day Amazon 131.5. Oh man, they're cheap. Now look, the market's not open yet, so these options prices aren't legit. They're just a kind of a ballpark, right? We've moved $1 in Amazon this morning, and that means these options prices are off a little bit. But if we find those 130s sitting at a dime or even anywhere near that at the open, I'm going to buy a couple of those because that's cheap. We have the potential today for that move. If you're uncomfortable with that, you could do a called debit spread, just turning it, like that. Buy the 130, sell the 131. Obviously, it's 10 cents this way. Your break even is just a little closer. If you buy deep enough in the money, it's like buying synthetic stock. So if you wanted to go that route, an $800 option is still cheaper than 100 shares of Amazon. And we don't have a half for the butterfly, but we could do a butterfly at, say, that 131. Yeah, look how cheap that is. And then since it's so cheap, we could just widen it out, right? 133, 131, 129. That's a $26 trade. And if Amazon lands anywhere between 129, which by the way, it's already there, and 133, there's some kind of profit if it lands anywhere inside that window. And if you're wrong, you're going to lose 26 cents. Now, obviously, you can keep it smaller, make it $1 wide instead of 2, and you could move it a little bit because the market is showing at the money between 128 and 129, right? And it still needs to adjust. So just keep in mind these prices aren't legit. And what if it dumps, right? What if we get one of those days like we had the other day where it ran all the way up there and then it ran all the way back down again? So it's something to keep in mind is we could get a half-day rip and then a rug pull. We could totally get that today. And you want to be prepared for that as well. Not just in Amazon, but I mean, in the market, we could easily get that upside run first and then roll her over and take her down. So just, proceed with caution. That's what I got, guys. Be careful, be safe. Have a great weekend. I'm pretty sure I'm going to be here Monday because it's a half day. So I'm going to be here. I get it though. If you guys don't want to be here and you take the long weekend, then I will see you on Wednesday. Don't blow any of your fingers off.